Now, the risk of the portfolio, as we discussed, is basically consists of two terms. One is beta square p, which is the beta of the portfolio multiplied by sigma square of the market. Another is basically the white noise. From this equation, there is the variance of the portfolio. You can have some feel of how diversification can be done. Now, assume for the time being that we invest in equal proportions n number of stocks, n or k if you remember, because I am using interchangeably. If there are n number of stocks and if we expand the equation, what you have is basically the risk coming from the market and the risk coming from the white noise, so on and so forth. Now, for the risk of the for the portfolio which you are forming, we will have basically the first term which is known as the non-diversifiable and the market risk, because if you see you cannot diversify that. There would be some beta p whole square and there would be definitely be some sigma square m. And in the second term, if we see, is basically being multiplied by the squares of the weight multiplied by the white noise. So, that is known as the diversifiable risk, because if you are able to proportionally put some proportions of that particular in that particular portfolio P, and the stocks are put in huge numbers such that each of them weights are n. So, what we have is Wi's are equal to W1, W2, W3, W4, all of them are equal to 1 by n. If n can be increased, then we see that technically the overall risk may be decreased almost to 0. So, if we see in a very simple terms the number of stocks which is there and the overall portfolio which you have. So, what actually can be, there would be a fixed line such that it basically consists of the market risk which cannot be decreased and basically the white noise. So, in the long run the overall risk can be minimized to the maximum possible extent, so such that overall risk which remains is the market risk, while the white noise which is the non-market risk or the non-systematic risk can be made 0 theoretically. Now, for all stock prices, if you remember that going back to few slides back, we consider the returns R is equal to the difference of investment which you have, which is I1, which is the investment which you are getting as of today, minus I0, which is the investment which we started with, divided by I0. Now, generally we consider that if concept of continuous compounding is there, what is continuous compounding? We will be discussing that within few days later on. If continuous compounding is there and if you consider the overall stock prices to be log normally distributed, we will see the returns can be found out using the concept of ln. Ln means this logarithmic with a Neperian log, E log, that is given by the stock prices for day 2 divided by day 1. So, what we will consider is not the opening stock price, the closing stock price or the adjusted closing stock price. So, if we have Monday, Tuesday, Wednesday, Thursday, so on and so forth. So, we will take basically the ln of Tuesday's closing price divided by the Monday's closing price to give the returns between Monday and Tuesday. If we have basically ln of Wednesday's closing price divided by Tuesday's closing price, we will basically have the returns between Tuesday and Wednesday, so on and so forth. So, the R values which you find use this formula is exactly the R values we have been talking about, is basically this. And we were interested to find out what were the returns and so on and so forth. So, we will see that the returns which we consider in the simple sense are related to this, and we will use the expected value of R using this formula and the variance of R using this formula, and try to analyze that whether they are normal or not. So, India we have basically BSE and NSE. The most well known indices are the BSE 30, and the BSE 30 has 30 companies, while NSE has basically 50 companies depending on how the structure is formulated. So, as on 2009, this is just a snapshot. We had this company starting from ACC in the BSE 30, ICC to Wipro. Similarly, for the S&P's Nifty, you had stocks starting from ABB to Reliance Communication. So, what the students can do is that later on we will come to simple assignments. Draw the scatter plots of S&P's Nifty, or for each of the stock draw the graph of the scripts along with the S&P Nifty and so on and so forth, and have a look at that how they basically vary with the market. So, again consider for 2006. So, if you have the open, high, low, close of S&P's price, if you see the close price which you have, this is the one which you are talking about. So, you want to find out the returns between these 2 days, it will be basically ln of 3138.65 divided by 3150 minus 0.95. So, this would be basically R1, and then you can find out R2, R3, R4. So, obviously, R1 and R2 can be positive or negative. So, we have the rates given, this is the column. So, you see some are negative, some are positive. So, based on that we plot it. Now, given, so we are considering a simple problem where you have ABC as a stock, and we consider S&P prices are again theoretical, starting from 12.28 to minus 1.15. So, if you have this, given the data information, you can find out the mean. So, how can you find out the mean? Add them up, divide by the number of reading. That will give you the mean for our IA. So, obviously, you may be thinking that should we use 12.205? No, these are the prices. So, what you will do is that first convert them to R. So, once you convert into them R, you will find out R bar, you will find out sigma of R. Similarly, if you have basically B, you will first convert it into R, which is the return for B, and this is the return of A. Similarly, you will find out R bar of B. Similarly, say for example, sigma R of B, and find out the variance and the expected value C and continue. So, what we also need to find out is that what is the correlation coefficient existing between A and B. So, this A and B does not mean the price, it basically means this, that is the returns A and B, they have some random variable, and then you find out the covariances and so on and so forth. For first 5 individual scripts, you have to find out for any company, those dates you can change, you can find out the time period between 2000, say for example, January 2015 to February 2015, and find out the corresponding S&P, and then try to plot them and try to find out the betas using the equations which you have already done. Next, you can basically take the Dow Jones and find out similarly how the betas plot. You can basically plot the data points and then basically use this equation to find y is equal to mx plus c, which we had discussed, which is also exactly equal to Ri bar is equal to alpha I plus beta I plus Rm bar. Obviously, epsilon is not there, it is 0. So, the next question is that how do you estimate the values of betas? So, we have been talking that beta is the slope, it is a tan of the theta, and it solves all our problem. The next question is how do we find out beta? We can use historical data to find out the beta. Now, to estimate the futures values of beta. So, the equation which we see is Ri is equal to alpha I plus beta I into Rm plus, but the white noise is generally not the same with respect to time, in the sense that both alphas, sigmas, then epsilons, r's, obviously they are changing. So, obviously they are at different fits of the line. In case we consider them to be independent with respect to time, then we have some straight lines, and these straight lines can basically combine together. So, what we actually mean is that technically this is the beta slope, but what we mean is that if the set of points are, if I use some other color options, so these are the points. So, what we think we need to do in order to find out the best beta would be, say for example, for the first time period this is the beta slope, for the second time period this is the beta, third time period this is the beta. So, rather than having a continuous beta, we are taking basically piecewise in order to estimate that. So, this is what we have been meaning beta, this is Ri's, this is the Rm's, and this is the alphas. So, the points are like scattered like this. So, the best fit is this. Rather than that, we can have the fits of different lines. And another thing which I did mention about trying to basically minimize the variance is that these points which are there, we are trying to find out the distance. So, this is the distance between y and y hat. So, basically these are the actual y's and these are the y hats. We want to try and find out the distance, square them up, square this up, there is another one, square it up, there is another one, square it up, another one, square it up, and add all of them. So, once you add, you want to basically find out the variances and then basically try to differentiate with respect to beta or alpha, which you already discussed. Now, for investment purposes, as we had mentioned, that if the betas are changing with respect to time and we need to find them. So, if we can easily prove that the values of beta are equal to basically the ratios of the covariances of the stock with the market divided by the market risk or the variance. So, if we expand that, we can easily prove that is equal to the sum of the differences, which is the covariance. You see, this is basically the first random variable minus the expected value, second random variable minus the expected value. Based on that, we can find out the numerator. Similarly, this is the variance. Variance is basically covariance of a particular random variable with itself. You can find out the variance and then find out the ratio, which will give us the value of beta. So, if you want to have different betas, consider a time frame. First time frame for the first linear equation would be, say for example, from T1 to T capital T. Similarly, for the variance of the market, second can be from small t is equal to T plus 1 to, say for example, twice T or some T2 value, and you continue doing it such that you can find out different values of beta. Similarly, given the beta, you have found out you already have the return of the market, you have the return of the stock, you can find out the alphas also. And similarly, given all these things, you can find out the white noise, which is sigma square epsilon i's. So, here this is what? This is the actual predicted value. They technically would have the alpha values, and this is the actual value. So, what we are meaning is this. This is sum them up, and this is basically the variances we are talking about. We may also be interested in determining the following coefficient, which is given the correlation coefficient between the ith stock and the market, which when converted to the concept of beta is given by beta I for that particular stock and the ratio of the market standard deviation with the stock standard deviation. So, now we see initially we had sigma square as a good measure of risk or the standard deviation. We also saw that there is a beta, which is basically the slope, which is another value of risk. Second, on later on we found out that what is the relationship between the beta of that particular stock with its own standard deviation. Remember, for all calculation above, we have assumed alphas and sigma squares and betas are independent in each other, even though that may not be true. Now, we extend our case for the multi-index model. So, till now we have been using the concept of single index model. The single index model is that there is only one market which basically dictates the price. In this multi-index model, we will just relax such that more than the market, there is other indices also, other factors also, which basically dictates the price. So, the basic use of multi-index model is to predict the correlation coefficients. Some others are to form expectation about the returns. It can also be method can be tailored to the return distribution of the portfolio, and method for attributing the cause of the good and bad effects which is happening for any particular change in the stock market for that particular stock. So, the multi-index model is just an extension of the single index model. So, in the single index model, you have alpha i's, you have the first term, these were not there. The third to the last one were not there, second last one were not there, and obviously you have the white noise. So, rather than basically having only one effect, we are basically subsuming in under, say for example, more than one effect, where now the I1, I2, I3 are the so called indices or the so called independent variables which affect the actual variable which we are going to study is alphas. So, again in the similar line, if we consider the assumptions always which we have already considered continue, expected value of the epsilon, which is the white noise, is 0, variance of the white noise is given, variance of the particular stock is also given. So, if you had the single index model, you have basically sigma square m. Then also continuing the same fact, if we consider the multiple linear regression where all of them were normal, we do consider that the relationship between the random variable which are independent do not affect each other. That means there is no covariance existing between the first random variable with the second to the third, where the first, second, third are all the independent random variable on the right hand side of this equation. So, this means the covariances are 0, and the last one which you have already considered is basically the covariance between each and every particular independent variable which is there with respect to the white noise is also 0. So, if what we need to find out is basically the expected value with respect to the multi-index model and the variance with respect to the multi-index model, and this return and risk are with respect to the market or the different indices for the particular stock which you want to find out. So, if you expand that, you will have return of the index is equal to alpha I, again similar way you had basically beta 1 I1, beta I2 and so on and so forth to the last term, where the now if you see the in the equation the white noise is not there because the expected value is 0. So, in the single index model which you basically would have alpha I, and this beta B I1 is basically the beta 1 which you already considered. So, basically these all means that they are the tan of these actual rate of change of the dependent variable with respect to the independent variable, considering all our others are constant, which means this would be the rate of change of the slope of y, which is the dependent variable with one of the x, considering the other x's are constant. So, if we consider the slope, it is basically the partial derivative. Similarly, if we find out the variance of that particular stock, so obviously variance, this is a constant term, it would not have any variance, and if we consider the variances of all other terms, they do come into the picture, and obviously this variance of the white noise will also come. But the interesting fact is that the covariances between the terms is 0 because you consider they are independent. So, now basically would, if we had k number of such variables, so it will be k plus the kth plus 1, which is basically the white noise. Similarly, if you want to find out the covariances between each and two different stocks or two different financial assets, considering that you are using the multi-index model, then it will be given by this formula, which is again very simple to understand. These are basically the covariances existing between B11 and BJ1, which is for the first and the second, multiplied by the effect of the variance which is coming from the first dependent one. This is B12 into BJ2 multiplied by the effect which is coming from the second one, and so on and so forth till if you consider k or L number of such independent variables. So, some variables which are used in multi-index models are the economic growth, what is the rate of change on the economic growth, what is the business cycle, long term interest rate, whether for 5 years, 10 years, for 1 year, 2 year, what is the short term interest rate, what is the inflation, which is the consumer price index, what is the foreign currency rate, what is Indian rupees to dollars rate. So, those can also be considered for the multi-index model. So, let me come to the, so these are very simple assignments which they can answer, but we are not going to discuss in our concept. So, now we will continue our discussion in portfolio analysis related to the averaging techniques. So, averaging technique or the smoothing techniques of the historical correlation coefficient or the covariance is required in order to basically estimate the covariance variance matrix, which is this. So, this is basically the covariance variance matrix for the population, and this is basically the best estimate which we will try to use from the sample. So, better averaging technique would be to assume that there is a common or mean correlation within and between the groups of the stocks for different type of markets, such that is to say that if you consider any particular steel stock, whether Tata Steel, Jindal Steel, whatever you have, or SAIL, it will have basically the same correlation coefficient between any auto industry, like Tata Steel to Maruti, Tata Steel to say for example Volkswagen. Well, I am considering these stocks are being traded. So, obviously the correlation coefficient would be the same between say for example Maruti to Jindal Steel or Jindal Steel to say for example Ashok Leyland. We will consider that in a very simplistic sense to be true. Moreover, the correlation between any steel stock and any cement stock is assumed to be the same, constant. To make this calculation simple, we will take this value as the average of all the correlation coefficient which is existing between all the stocks taken 2 at a time. So, simple technique for determining the efficient frontier will be, we consider the single index model to be true, and we will consider the constant variance covariance matrix to be true. So, we would be interested to find a single number which is a measure of the desirability of including a particular stock, but now we will consider that over and above the particular stock or the set of stocks which are risky, we will also have the risk free interest rate, which is given by the concept of R suffix f. So, this means if you see the difference on the top, which is the numerator, it gives you that how good or bad that particular stock is with the respect to the risk free interest rate, because if the stocks returns are not as good as the risk free interest rate, obviously I would not invest in the stock. If it is better, obviously I will definitely like to invest. Now the second question is that if you are in only concentrating on RI minus RF, this only gives a one-sided or lopsided view of the market, in the sense it only gives us the return. What about the risk? So we know that we consider risk as, for example, sigma, we can also consider the risk as the beta. So what we want to find out is basically the ratio between the overall return difference which is there in the numerator and the risk which is given for the particular stock and the beta. This means that the additional return over and above the risk free interest rate divided by the risk of the market of that particular stock with the market would basically the best measure that how good or bad it would be to include that particular stock in our portfolio. Now if there is no short selling, then if this ratio is negative or 0, we would not include that. If there is short selling, if the ratio is negative, obviously we would include that. That means we are going back to the concept of Lintner's definition and all these things we will see in a simple case. So without short selling, if the ratio is greater than some C star, we include. If it is less than C star, which is negative, we do not include. That means all would be 0. The values of that weights would be 0. And with short selling being there, if they are greater, we include, even if they are less, we will include, but in the short selling sense. The problem has the condition that short selling being not allowed and riskless lending and borrowing being allowed. That is the first instant. The rule works as follows: find the excess return of 2 beta ratio of each every stock, rank them, obviously we will rank them, and then from the highest to the lowest, the optimal consists of investing in all the stocks such that the ratio is greater than C star, not investing in those particular stock where the ratio is less than C star. So we need to find out what is C star. I will going to come to that within few minutes. So consider a hypothetical data. The first column are the stock numbers 1 to 10. RIs are given from 15, 17, 12, so on and so forth. And RIFs, which is RI minus RF, which is the difference between the risk free interest rate and the particular stock return, where the risk free interest rate is given as 5% is given. So we have ranked them. We have already ranked them according to the maximum to minimum, and now we have maximum to the minimum in the sense that this, if your actual aim is to find out the ranking with respect to the ratio. So I am saying that with respect to the ratio, the ranking has been done. We have the betas, which is already given, and you have the sigma square, which is the white noise for that particular stock, and on the last column you basically have the ratio. So what we see is that the ratios of the first is 10 and the last one is 1. So we want to basically make a decision that at what stage should we cut off so as that that particular stock is included, other stock would not be included considering short selling is not there. So we just go through this concept of the rule. This is the extension of the Excel sheet which we have. If you see it, the last column was basically the ratio. So here the first column is basically the ratio. So we find out the ratio between the difference in the returns by the white noise multiplied by beta. So they are ranked. Then we find out the beta square into sigma square. So what we are doing is that we are trying to find out the ratios of the internal risk of the particular stock with the white noise. And then we start summing it up. That means we are trying to sum up the third column. The first column being basically the ith score stock number. And in this case, on the last column, if you see, we basically sum up or find out the cumulative values of the ratio, which is beta square j by sigma square j. Now, the CI values, what we want to find out based on which we will cut off, is given by the formula without the proofs, is given by this. So C1 would be for the values of j is equal to 1 to I. So you make a subtle difference between the index of j and I. So C1 would be j is equal to 1 to 1. And then you find out this ratio which is given, which you already found out, plus 1 by sigma square into the ratio which is basically already found out. That means these ratios which you find out on the numerator, this one and the next one, are already found out and given in the table in the slide number 205. So now when we rank them, so as we are ranking them, you will see a very nice thing. The CI values start increasing. At a certain value of 5.45, after that it starts decreasing, which means that if you keep adding the stocks which are 6th, 7th, 8th, 9th and 10th, basically it means they would give me negative values if short selling is not there. That means we will only consider in our portfolio the first, second, third, fourth, fifth, and the weights would be decreasing. That means, the first one would be the highest one, similarly the last one will be the lowest one, considering the cutoff is, say for example, 5.45. So, this 5.45 is basically the C star value which I was talking about. So, C star implies that for all stocks, if they are greater, include; if they are less, don't include. So, remember one thing, the summation is being done from j is equal to 1 to I, which I just mentioned. So, be very careful when you do the summation for C1, C2, C3, C4, where the j index would change only from 1 to that value for which you are trying to find out the C value. So, Wi's are now found out using this equation. So, these are the differences which you already found out. Greater it is, more it will be invested; less it is, it would not be invested to that extent. So, Wi's will be given by the formulas which you can check in the book by this one, and the C star value which you have already found out is given by the equations till the nth stocks where it is positive. So, this n does not mean the whole set of stocks, as I was mentioning. So, it will be some small subset of this. Whole set of assets is not included, but only the set of assets which have been included in the portfolio. Hence, in our example, it is 5. So, if you go back, first, second, third, fourth, fifth are included. Hence, they would be n is equal to 1 to 5. So, once you find out the weights, these are the weights. But very interesting thing, note, if you add them up, they are not equal to 1. What we need to do? We need to normalize. When we normalize them using the simple normalization concept we have already done, then if you add up, the weights add up to 1, which means that out of this 10 stocks, you will include the first 5 with weights 28.4, 27.6, 22.0, 19.5 and 2.3. And once you have found out the weights, you can find out the overall return on the portfolio, sigma of the portfolio, and then proceed to find out the efficient frontier accordingly. If short selling is not included, we have considered the case where short selling is not included.